Are you looking for even more reasons to invest in real estate? Well, let me share with you today some of the tax benefits that can help. So, if you have not joined us before, I am Becky Nova, and welcome to Live Free with Becky Nova. I am the founder of Lady Landlords, where we help women achieve financial freedom through real estate investing. So I'm recording this now in mid-April. So do not worry though, if you're watching this hoping for some tax tips, you now in 2021 do have some more time to still be able to file your federal tax returns. We have until May 17th this year to be able to get that information in. But there are a ton of reasons why real estate investing is absolutely fantastic. Now, we hear about all the regular options all before. Everybody usually wants to get into rental properties because of the monthly cash flow that'll bring you, for the appreciation over time of what that building would be worth. And those are all really important things. But tax benefits for homeowners and for those of us that would own rental properties can be huge and a game changer for real estate investors. So those are what I really wanted to kind of talk about today. We all know about some of those other options, but this one I want us to get a little bit more deep dive into it. First thing that I want to share about thinking about tax benefits is you want to make sure to have an accountant on your side when you are investing in real estate. There are tons of different benefits and opportunities that you can have when investing in real estate. But that's why it's important to make sure to work with a licensed professional that will walk you through your personal situation of what's going on. I personally have my CPA. She's very well versed in real estate investing, and she's somebody that I've worked with for years now. And as my portfolio has continued to grow and expand, what's great is that she and I have that existing relationship where we can talk about those changes and what is happening and make sure that I am taking the advantages where I can and talking through some of the different options that I have as a real estate investor. If you do not have an accountant on your team now and would like to speak to mine, make sure to head over to our website, lady-landlords.com, and you can reach out to my accountant there. I'll also make sure to put that down in the show notes, both if you're watching this on our Lady Landlords podcast or if you are watching this on our YouTube channel at Live Free with Becky Nova. So let's talk about what some of those benefits look like. One of the first and the best thing that kind of comes to mind when I think about tax benefits is the idea of tax deductions. Now, you've probably heard about these. If you were a Seinfeld fan, you might remember Kramer explaining to Jerry about how large companies just kind of write things off. And Jerry was questioning him, being like, what do you mean write things off? It was a great skit. If you haven't seen that, definitely head over and Google that on YouTube too. But now, instead of a big corporation having some of those benefits for tax deductions, that's actually something that we as an independent real estate investor can use. And we can use that in two different ways. The first way we're going to talk about that is just in the sense of actually owning now rental properties. So now that we are a real estate investor, the deductions that we can take are related to the fact that now we own property. And here's how deductions kind of work. Let's say, using nice round numbers as an example, that you make $100,000 a year. Well, when you take deductions, let's say now you are able to show that you had $10,000 in expenses on your property now, or through your business, now you would actually have a income of only $90,000, right? $100,000 minus those $10,000 of deductions, now you're down to $90,000, which would actually lower what your taxable income is. Remember though that you do have to report your rental income. So any money that you actually made from your properties, that does get included in your income, which means is taxable. So the deductions are a way to be able to help offset those, especially with the other costs of owning rental properties. So some ideas of what would count as deductions for your rental properties would be, for example, any type of materials that you have to buy if you are making for your maintenance or for smaller improvements to your house. If you have a tenant that moves out and you need to hire a cleaning service in between tenants, that is actually a business expense. That is something that you can actually deduct. Also, one of the things that I know is a big stressor is having to travel to my properties, having to travel to go meet contractors, going to Home Depot and different stores to pick up different products that I would need. that travel is actually something that also counts as a deduction. So those are things that you can actually use to then offset that extra income properties that you have that you now are reporting. So when you have all of those different options coming in, you want to make sure to kind of keep a running list of those. So you need to be able not only to provide that to your accountant, but then also that's something that the IRS might also actually ask for. So you need to be able to keep track of your expenses and your income throughout the year. This is one of the reasons that it's really important to be able to track the payments that you not only receive from your tenants, but then also be sure that you are tracking your expenses. This might be something that you want to do through a rental property management software system. This might be something that you want to be able to do through Excel or through a system where you are accounting for everything based on the credit card or the checking account that you have associated with that specific property. That's a great way just to see monies coming in and out. When you do that, though, you want to make sure to also group what those items are. So, for example, if you had to get a cleaning crew to come in to manage the property when you're flipping, and then you also have to have the apartment painted in between tenants, that might go into a category of tenant management. Let's say you are a person that includes utilities, or you have your internet service and electricity for either common space areas, or if you have security cameras on your property, those then would count under utilities. So you want to make sure to group those items together. That will be a best way to help your accountant. But you also need to make sure that you are tracking and keeping the receipts and bills to be able to prove that that was the monies that you really spent. So head back if you haven't listened to our bookkeeping episode with our member spotlight with Grace Drew Wills. That is an episode that you want to go back and look to hear all about great ways that can make sure that you're tracking all this information well throughout the year, which will make your life a lot easier when it now comes to tax time. Now, we talked about those real estate related expenses, but now remember that you also have a business. You now own rental properties. That means that you can also deduct regular business expenses, such as maybe a printer because you have to print out leases. Once again, try to think electronic and save a tree. But if you're printing out leases, that printer, there are also ways that a business expense might possibly be the computer that you're using. A home office is a possible tax deduction that you might be able to take, also depending on how you set up your business. But those office supplies, meetings that you have to go to, accounting fees, lawyer fees, all of those things are included in your business expenses. And that can really make a difference in what your taxable income can be. Remember that as of right now, the most of deductions that you can actually take, the highest amount of deduction that you can take is up to $25,000. So once again, if your reportable income with either a certain job that you have, a side hustle, and your rental properties, let's say once again, using a round number is $100,000, you can actually take deductions, assuming that you have the proof and you actually used those deductions, would actually, your reportable income could possibly be lowered to at a maximum of $75,000 as reportable taxable income. So that would mean a big difference in what you're paying in taxes. The one caveat to that, though, is remember that if you are planning on purchasing more properties moving forward, you need to have your DTI checked, your debt to income ratio. So what I've seen happen before that can actually hurt some investors is by taking too many tax deductions when then they're looking to buy property. So for example, as we said, if I have that $100,000 that I made, but with $25,000 tax deductions, I now have that income of $75,000 in taxable income. That's what that lender is going to see when I now go to get another mortgage. They're going to say, but look, you were only able to make $75,000. That's what you had because of the tax deductions. That might hurt me, depending on what other debts I have, depending on what their DTI ratio that they are looking for is. That might actually make it a little more difficult for me to be able to get property moving forward. So keep that in mind when you're trying to plan to purchase your next properties and how you do that. Once again, that's a really big reason why it's so important to have an accountant on your side to not only talk about what happened in the past year when you're filing your taxes, but also what you plan on doing in the future moving forward, because you don't want to set yourself up where it now makes it a little bit more difficult to purchase property because you didn't have as high of an income because you took too many tax deductions. So keep that in the back of your mind as you're building your portfolio. The next item that I want to talk about that helps as tax deductions is what's called depreciation. Depreciation in its most simple form is just saying something that you bought is now getting older, right? So, for example, when you buy that house, that roof, maybe you bought that house, and the roof was brand new. Well, every year that roof is going to get older, just like we do as people. And things start breaking down and they start not working as well. So you can actually take a tax depreciation which counts as a deduction, where you can not only take it on those larger items, which we call CapEx, which stands for capital expenditures, which are your large items. That's going to be your roof. That's going to be your driveways, those things that are going to cost a lot of money. You can actually do that, and you're able to take a depreciation on your property in general as a whole rather than itemizing it, i.e., roof, driveway, whatever else. But you can actually take that as a whole on your property, and you can actually take the deduction for up to 27.5 years. That is what the IRS has set that decision at, but it is just a number for whatever reason that they came up with that. That is really stating that for the long term, you can actually use that deduction. Once again, you want to be careful about how you're using that because you don't want it to get in the way of you purchasing properties in the future. But that is a really good option. And that is a great option if you are a person that had to do a lot of updates to a property. That is a great way to then help with some of the deductions and because of the costs that you had to spend to make those capital improvements. The third way that I want to discuss that will help with your tax benefits is the idea of deferment. Deferment is the idea of not paying taxes now, but possibly paying taxes in the future. There are a ton of reasons we might want to do this. One of the biggest reasons for that is because if you are actively investing in real estate and if you are actively working a full-time job, you might be in a situation where you make good money now, or you might just be making more money now, today, than you will be making when you retire. So this works kind of in that similar way if you're familiar with IRAs. You want to make sure that you are paying taxes when your income then would be the lowest, because then you're paying less income taxes. For example, if today I make $100,000 as a base salary, I'm going to be paying more taxes than possibly when I'm retired and am living off of $50,000. Now, we clearly want our salaries to go up. We clearly want to be able, especially if we have these rental incomes coming in, we want to also be careful with that because my goal is to actually be making more money in retirement and then when I'm older than I would be now. So keep that in the back of your mind. But it is a strategy we can play with. One of the most popular ways that you will be able to think about this is through capital gains. Capital gains, simply put, is the profit that you make when you sell an asset being your property. So let's say now going back to that property that I have that I bought for $100,000, if that property now when I go to sell it, I sell it for $150,000, I just made $50K. That sounds great, especially if I'm flipping that property and I want to make that money in that short term. But remember, you have to pay taxes on those capital gains. So that $50K would now count as taxable income. That also would be the same even if I had a rental property that I owned for 30 years and now it had a higher appreciation, right? Now that property 30 years later is going to be worth a lot more money. Same example, maybe I bought it $100,000. Now I'm selling it at $150,000. I now have $50,000 that I need to pay taxes on. So one thing that you could do to defer taxes, to not have to pay those taxes today, but possibly pay them in the future. Maybe there's a way to get around that too if you keep listening into our session today. But one of the ways that you can actually do that would be through what's called a 1031 exchange. A 1031 exchange is a process that allows you to sell that property, still have that profit there, but you don't pay taxes now as we're talking about deferment. You can actually purchase another property of similar or like value and similar style that you can now purchase with that money, and now you don't have to pay your taxes on it right now. That is still a great way to be able to take your profit, move your funds around a little bit, and now you still have that profit, but now you also still have an asset because now you bought another property. Great way to be able to go And you can also roll that into continuously buying larger properties and also upgrading what your portfolio looks like. So you're always making sure to get the highest cash flow and the best appreciation from your properties. So this can be a really, really helpful strategy. The most important thing with the 1031 exchange, though, is you have to make it very clear from the very beginning that this is what you're going to be doing. So, for example, if you try to do a 1031 and you sell your property and you at any point receive the funds, you can no longer do that 1031. That means that basically in the process for 1031, it needs to stay in the deal. You cannot take that money out. You cannot access that money. We're not buying other properties or other things or material items with that money. That is something that has to stay within that deal. So make sure to read up on your 1031. You might be getting a video about that soon and a podcast about how 1031 exchanges work, because it really is a process you have to follow. And there also are time constraints that you have to meet. You have to be able to close on that newer property in a certain period of time. There's no way that the IRS is going to say, hey, we will not let you pay taxes this year, but yet you're not going to buy another property for 2, 3, 4, 5 years. Not going to work. The IRS is not going to allow that. So you want to make sure that you understand the process and you have somebody that can advise you through that 1031 exchange. Now, one of the ways that now you're saying, great, well, I deferred my taxes, but that means I still have to actually pay them on those capital gains. One thing to keep in mind too, that you might want to upgrade if you're thinking about how you're building your portfolio in the long run, would be the idea of taking that property, taking that 1031 exchange and rolling that into a property where then you're going to currently live. If it is a property that you lived in as an owner occupied property for a few years, then you actually would not be paying the same way that you would for capital gains as if it was an investment property. Just as much as there are benefits when it comes to mortgages with down payments, where you only have to put down 3.5% or 5% when you are purchasing a property that's going to be owner occupied, it also is beneficial when you are selling property if it is a property that you lived in and was an owner occupied property. So it gives you a great opportunity then later on in your real estate career to be able to upgrade your own personal property. And maybe you've been living in house hacks and multifamilies your whole life, and it would be a great time for you then to upgrade to that single family property. And then when you live in it for a couple years, then it's an opportunity to also then lower your taxable income. So just a couple options to keep in mind. Like I said, this is why it's really important to make sure you have an accountant on board, but also why you want to make sure to think about the direction that your portfolio is going and how that's growing. If you need any help with that, feel free to look into the Lady Landlord's Roadmap, where we sit down and go through your personal situation. That is a one-on-one session with me where we talk about your personal situation and we literally write out step by step about where you're actually trying to get to within your real estate career and what goals you're really trying to reach. Then we look at your different finances and the different options that you have to be able to reach those goals. And then I give you a step-by-step plan of what you need to do in order to be able to reach your real estate goals. So if that interests you in any way, I put also the link down in the show notes on our podcast and also on our YouTube channel. So take a look there, or you can always find me in the Lady Landlords Facebook group and also on Instagram at BeckyNova24. Thanks so much, and I hope these tax benefit tips helped you out. Bye.